Hey everyone, Ash here with the Better Than Yesterday blog. Now that you've advanced from bookkeeping for beginners, it's time to move on to the balance sheet. We already know that the profit and loss statement shows what your business actually made for profit in a given period. And the balance sheet shows the book value of the company, or in other words, what the company is worth. This financial statement shows the assets, liabilities, and owner's equity. And if you've ever taken an accounting class, then you probably remember that assets have to equal liabilities plus owner's equity, because it's a balance sheet and that's how it balances. Assets are anything valuable that a company owns, and they're usually broken up into categories like current assets, fixed assets, or in other words, property and equipment, and other assets. Current assets are usually cash, bank accounts, inventory, basically anything that is a short-term investment or can be converted into cash within 1 year. Fixed assets are long-term investments held on for longer than a year and cannot be easily converted into cash. So for example, land, buildings, equipment, things like that. Liability is basically just a fancy word for debt. This shows everything that the company owes. And it's also broken out into categories like current and non-current liabilities. Current liabilities can be settled within 1 fiscal year, and non-current liabilities are usually due after a year or more. Then equity is the ownership of the assets and the liabilities. This category contains retained earnings, contributions, and distributions. Understanding how to read a balance sheet and an income statement together will tell you most of the financial story of a company. Although we do still have one more financial statement that will tell you the rest of the story, and you'll learn that in advanced bookkeeping.